Hey traders, Raghee here. Welcome to Charts and Coffee. Hope everyone is having a very nice Wednesday morning. This is really the start of the week for all intents and purposes because the events and the data that we have coming out are really going to determine whether this weakness that we're seeing, taking a look at these indices heading lower, the weakness that we're seeing, whether that continues or whether that again abruptly shifts as the focus goes from one thing to another. What are the things that we're focusing on right now? We do have earnings right around the corner, and I can't say that the kickoff of earnings is going to be particularly awful because one of the sectors that did not give a rip about the weakness in the indices were financials. And we're inside that 2-week window on the 642 earnings window that I use for swing trades. We're in that window and XLF was doing just fine. In fact, there were a number of sectors that were doing just fine, even though the broader averages were having a bit of a day, right? So remember, we don't want to think about the markets. We want to think about individual indices, their individual sector weightings, and their individual stock weightings. And you'll see sometimes these sort of outliers emerge. And it could be the best downtrend of the group. It could be the sector that's defying the downtrend, which is exactly what happened yesterday. By the way, when we have financials and healthcare defying the downtrend in the indices yesterday, that does tell us financials and healthcare, we got to keep an eye on the Dow and the S&P. So that's going to be something I'll be doing today as well. Another thing that I would definitely consider is weighting. This is something we did yesterday. There are a number, dramatic sip of coffee. There are a number of sectors and stocks that are pulling back to their daily price movement ranges. And for sure, these are the kinds of names that I'm interested in. The top three are Microsoft, Meta, and Amazon. Not to say there are not others, but when I think about the Magnificent Seven, maybe not so magnificent at the moment. We had some sector rotation yesterday. We saw tech, we saw semis rolling over a bit to the downside while laggards like XLE and healthcare were moving up. So a little bit of sector rotation. What's going to snap the market out of it though? What'll snap the market out of it will be whether or not we can get the data today at 10. We have ISM, PMI, we have JOLTS, and then at 2 p.m. Eastern, we've got the minutes. So we've got the sort of the notes, the cliff notes of the last meeting. And all of that together is likely going to either accelerate the weakness that we're seeing at the moment, or it's going to reverse it. And such is the way of data, right? Now, I would not in any way, let's kind of move this 5-minute chart aside. I would not in any way suggest that, look, gang, there's so much hyperbole out there because look, maybe I've always joked about this, so much of analysis is really just clickbait anymore, right? This is what the S&P has been doing. This is where the futures sit right now. Is this a meltdown? No, we've just been so used to higher highs every day or follow through that potentially 3 down days is probably darn near time for a markets in turmoil special, right? But the fact of the matter is this is still very much an uptrend. If I take a look at the S&P and then I'll follow that up here with the NASDAQ, right? NASDAQ was in fuego, all-time highs last year. Let's not forget that. Yeah, it's pulling back a little bit, but this is the difference between retracement or mean reversion trading and buying at highs, expecting higher highs. Neither is right, neither is wrong. It's just a matter of remembering where you're positioning yourself on the chart. I don't like to position myself at higher highs. Sometimes that works. And anyone who did that basically from the 7th of December to the 18th, that's a good stretch, right? Anyone who did that then was very rewarded. But if we apply that same strategy now, you're getting your you-know-what handed to you. So this is where it's not a matter of which is right. It's just a matter of knowing how you're going to manage risk. And so for me, I look at this, and this is a blue light special. This is akin to that blue light spinning around in the middle of Kmart. I want to see that pull back to either the wave or the daily price movement range, and certainly Jolt's FOMC meeting minutes, and maybe even that PMI, the Purchasing Managers Index, could be the reason for that. So again, I'm not predicting. For crying out loud, gang, we're all adults here, right? Nobody here really thinks anyone predicts where the markets are going, right? No one here really thinks that's our job. Yes? Don't saddle yourself with that. We react, right? We react. We're counterpunchers, to use a boxing analogy. We're the batter at the plate as the pitcher, the market's throwing whatever they're going to throw at us. We react to what we get. And right now, what we're getting is a pullback. I love this. This is basically the foundation of my career. Healthy trends retrace. And that's what I want to definitely take advantage of. All right, so that's a quick summary of what's on my radar. And yeah, lots of sector rotation. And I don't say that haphazardly. If you've been reading Top Tier Outlook out there, gang, you know that we've talked very specifically about what sector rotation would look like. What's at the top of the Ferris wheel? What's at the bottom of the Ferris wheel? At the tippy top, semiconductors and tech. At the bottom, energy and healthcare. And if you take a look, we did a lot of this work yesterday. If you take a look, that's what was turning. So that's what sector rotation looks like. And it doesn't have to continue for days or weeks. It could be a session of sector rotation. By the way, rotation could turn into participation. We could start to see inflows in both the top weighted sectors and the bottom, and it lifts the high, it's a high tide lifting all sectors. So it doesn't have to be rotation, although that is what we saw, but we need to keep an eye on participation, broader participation as well. Yeah, amazing. So did we go with any swings, group? Nope, I'm waiting. I don't want to look. We looked at the markets together in the Sector Secrets Mastery at 3 p.m. and I said, look, if we are closing heavy, and there's criteria for that, if we're closing heavy, we look at the multi-trend, we look at the structure of the time frames, chances are when everyone goes home and everyone wakes up the next morning, it's not bullishness that they're waking up with. Not to mention, we weren't at the levels. Should I pay attention to the FOMC minutes? It's from last month. Tony, anything that's new data is definitely worth keeping an eye on. Yes. And as far as rotation, yeah, exactly what we said. But it's not just random. The whole idea is to know which could be rotating, which are the ones that are going to see profit taking, which ones are going to be the ones that'll see the inflows. And it worked exactly where, again, the top of the Ferris wheel, if you will, think about the Ferris wheel spinning, the top of the Ferris wheel, the bottom of the Ferris wheel, that's exactly what was spinning. But yes, I would pay attention to that hot zone, Tony. That's my 2 cents. All right, Stephen, let's see. You like a trend, and John, okay, I'm sad. Hang on, Steve. Let me read this. My coffee may not have kicked in. Like I said, pre-trend squeeze. Why do you prefer? Okay, I like a trend, so we agree on that. Why do I prefer a move in process over pre-running with a squeeze? Why? 30 years. That's what's worked for me. Why do some people like pineapple on their pizzas? It's preference, John, at the end of the day. Stephen, whether John likes a squeeze or not, whether I like to follow trends, they are taking advantage of the same thing. And a lot of times, I'll tell you this, a lot of people say, Rog, do you use squeeze? You will notice, and I'll give you all a little tip right now, they overlap. So we're not at opposite ends of this. It's just preference. Why do some batters like a certain pitch? Why questions are kind of tough questions, Stephen. That's to presume that there's one way to trade the market, right? Why do you like this? Why not that? Because they both work. They both work, right? But I'll tell you this, they do overlap. This is the cool part, Stephen. Ready? And everybody, they do overlap. If you like my grab candles in the wave, and if you like the squeeze, I'll tell you this, look for spans of time on a chart, doesn't matter the time frame, although I prefer the daily, for at least 4 blue grab candles in a row. If you want to add another really cool tool, a narrow Darvis, and you will see how often that is going to overlap and actually increase the accuracy of your squeeze. Squeezes are great, right? I just find that I'll end up by retracement trading or taking advantage of Darvis and blue grab candles. I'll end up overlapping that. So there's just lots of ways to take advantage of continuation. And at the end of the day, that's what John and I both are trying to do, right? We're not out there trying to pick tops and bottoms. When we are both trading at our best, we are trading with the flow, and just the way that we engage the flow is just a little different. All right. So next up is, oh yeah, I want to remind everybody, yes, I've been talking a lot about DPMRs. I would hate you all to miss the sale. They are really powerful at the moment. Take a look at any chart. If you want me to pull up one of your charts and we have the DPMRs running on them here during Charts and Coffee or in the rooms, let me know. I have a lot of people saying, hey, Rog, could you email me that daily chart of Tesla again with the DPMRs? And they wanted to see how many times the candles head into the daily price movement ranges and with the green grab and head higher. And it's, well, a lot. So, take a look at maybe that tool or any others that you've been interested in at the Simpler Trading store. Take advantage of the sale. It ends Friday. All right. Hot zone today. Is it good news? Is good yet? Tony, I would say not quite yet, although I'm trying not to predict. I'm going to just respond to what we get. If we're looking for a March rate cut, in fact, let me show you where I'm getting this data from, right? I'm not just guessing and prognosticating. No way. That's never paid the bills. All right. So if I'm taking a look at the FOMC target rate probabilities for, forget January, that's a non-starter. Take a look at March 20, May 1, June 12. And what you'll see is the expectations for those rate cuts. Right now, is anyone surprised? And if you've never seen this data, is anyone surprised that we're actually moving a little bit lower right now on the expectations for those boom, boom, boom quarter point cuts? Not significantly so. We track these in the Sector Secrets Mastery on a regular basis, and I'll give you an example. This was at 70 point, I think 4 or 5%. So we've notched down maybe 3 percentage points, but it is a little bit lower, right? So when we see movement lower in equities, and then we see a slightly lower probability of a rate cut, that's really in sync. And it tells us that a lot of the expectations for higher highs are also tied to the expectations for lower rates. And so we can measure these things. After jolts, we'll come on back to this data and say, hey, what happened after jolts? After the FOMC meeting minutes are released, we'll come on back, because what I want everyone to realize is we don't have to guess at what the data means. Sometimes, what does the number versus the expected versus the 4-week average, what the heck does it mean? It only means what we expect in this environment, the rates to do, right? If you want to have a way of saying, look, which way is the wind blowing? Come here. Go to the target rate probabilities. They're available free at the CME Group website. It's called right here, CME FedWatch tool. You don't have to guess. And by the way, when everyone's giving you their numbers about what they're expecting, it's this. It's a futures contract that talks about, that explains to us, traders and investors, what the expectations are. And believe me when I tell you, Powell knows what these are. He's not going to defy them. He will adjust them accordingly. So the next time he speaks, or any of the FOMC voting members especially, and they start talking a little less dovish, they've probably looked at this data and said, hey, everyone's expecting too much from us too soon. They have yet to do anything like that. So right now, I've got to, based on data, presume that they are okay with the broader markets, us, right, rallying, because March, May, and June are very likely going to be quarter point months. And with those cuts, the concern for too high for too long, the rates being too high for too long, take a look at bonds. Take a look at the US dollar. In fact, I'm going to do that right now. Take a look at the ZB or TLT, whichever flavor of the long bond you like. Take a look at 6E, right? And use these things to measure what ultimately all this means. All right. So hopefully, and I don't mean hopefully as in, oh, we want to trade up markets, but up markets are easier to trend. And hopefully this continues to have the traction, which I expect it will, because everything's lining up. We have a really great year ahead of us. Alex, 241. I've been trading since 2011. Very cool. This rate adjustment period of the past few years has taught me more about the markets than anything else. Almost wish I had learned now instead of then. I'll tell you, Alex, I'll tell you this. Alex, I was doing teaching and a lot of trading in 1997, 98, 99, 2000. And it was the absolute worst time. Best time to be a trader, worst time to be a teacher, because everyone's trading accounts were going straight up because of skill or because tech bubble, right? Rocket ship. And so I will tell you this, Alex, traders who learned in 2020, I will tell you easily 8 or 9 out of 10 got wiped out in 2021, 2022. They have no idea what to do to 2023. It's not their fault. But if we're calibrated to, oh, this is what trading is, think of 99, 98 in tech. They don't know what to do, in fairness, because they haven't dealt with it yet. You've just gone through what I guess SEALs would call Hell Week, and you survived. You're still here. Your account's intact. If you've gone through Hell Week, an uptrend, that's a picnic, right? That's a day at the beach. Chop, you know what to do with it. So I actually feel sad for people who enter the market in those crazy uptrending type environments and think, oh, this is what trading is. They're not equipped for what's really trading, which is kind of what 2023 was about. So I hear you, but believe me, we're going to get our lessons one way or the other. The market spares nobody. All right. Is it time for DUK? I'm not a big fan of it. I'm not a big fan of defensive, Munir. Of all the things that I could get into, is it staples? Is it utilities? Is it XLRE or VNQ, REITs, and real estate? I can't say they're high on my list. But as far as an outperformer within the utilities, sure. I mean, in its own right, it's heading higher. I just don't know that my focus is going to be on the more defensive corners of the sector in terms of tech and financials and healthcare. Am I going to go with consumer staples and energy and utilities? Probably not high on the list. All right. Next up, great info. Michelle, I'm glad you like it. Yeah, there's ways to take, look, there's a lot of traders here at Simpler who use the squeeze and something else, or they use the squeeze with a tweak. And I think that's the best way. There's a lot of traders who use my grab and my wave and my DPMRs with a tweak, right? That's what trading is. That's what it is. You take a basic recipe that you know is a foundation for a darn good meal, and you say, you know what? I'd like a little bit more heat. I'd like a little cayenne in there. You know what? I like it a little bit more salty, whatever it is. I like it a little sweeter, but the basis is there, and that basis should be time tested. And by that, I mean decades, which is exactly what John and I bring to the table. Decades of, hey, we did this through multiple iterations of the market, and it still works. Yeah. All right, Lily. So if we're taking a look at healthcare, I want relative outperformers. Lilly has been generally one of those, but right now it's not. So our list really looks a lot more like Merck at the moment. Michelle, AbbVie, I believe Thermo is another one that's been a little bit more bullish. So I do like healthcare. Lilly just isn't at the top of the list. By the way, neither is Johnson & Johnson. All right. All right. Next up is, how do I judge the pullback to buy versus a decline to avoid? Great question. This is a great one to kind of wrap up on. So the way that I do it, really simple. Everything that I'm doing is automated in terms of the analysis of the structure of the market. I'm not going to guess at it. I'm not going to let emotion rule it. By the way, how many people were gonzo bullish on Friday when you were listening to analysis and are suddenly bearish now? That's not the way we want to do things, right? Things don't switch that quick. So what we do is we take a look at the multi-trend. So I'm always looking for trends first. The S&P is in a trend. This is a viable pullback. Both the momentum and the trend are still bullish. We're still above the wave. We're still not even touching the daily price movement range. We're well north of the 200. These are the kind of pullbacks that I want to focus on. Now, I'll show you one that I'm a little hesitant on. And not so magnificent, 7, Apple. Apple, I'm going to be a little bit more hesitant on. Apple lost the trend. It's the 4th session that it lost the trend, lost the momentum. It's neutral, not bearish, right? But I've got to set it up differently. I got to use my slow stochastic, my sector slow stow. It's a 21K 3D. I got to use this in lieu of looking for a trend. I've got a bolt, gang. I got to be in this options room in the mastery right now. I'll see y'all tomorrow, same time, same station. Be good to each other.